Well, ladies and gentlemen, thank you very much for your time this evening. I worked for UBS for 15 years and spent, I don't know, more weeks than I can remember in Zurich. So this feels like I'm coming home, so thank you very much. I now work for the World Gold Council. We are a market development agency for the gold industry. I'm going to talk about the current state of the gold industry, talk about what's been happening in demand, talk a little bit about some of the prospects for investment going forward, and then share with you some of the slides, some of the arguments that we use to try and get gold into institutional portfolios. I hope this technology works. I'm always, even though I tested it before, I'm always a little bit scared. Okay, that's good. So first of all, talking about the demand outlook. And it's upbeat. Well, you would expect that coming from the World Gold Council. I'll talk about these countries here and certain aspects of it in more detail. I start with China and India, and that's obvious, I think, because China and India make up about 50% of the demand for gold. We'll touch on technology, which is something that the World Gold Council is spending more time talking about, because I think it's more important than we've been giving it the attention in the past. I'll talk about how Germany is really the paragon of a gold market, and why I said to an internal gathering of the World Gold Council staff, I want everybody to become German, and you'll see why. I'll talk about Turkey. We'll touch on the US jewellery market, and I'll show you how a 400-ton market can become about a 130-ton market, and how the prospects for that are finally turning around. And then we'll talk a bit about Vietnam. So first of all, let's talk about China. China has been, I think, the biggest success story in the gold market in the last 10 years. This was a 200-ton gold market around the turn of the millennium that's peaked at about 1,300 tons and is still currently a 1,000-ton market. Now, this massive growth that we saw in China was very simple. This was when a government gets behind gold and actively promotes it to their population. The economic growth we saw in China obviously wasn't much of a handicap either. But China launched the Shanghai Gold Exchange in the early 2000s, opened up the market so that individual investors could buy gold, and we've seen the jewelry market grow as well with the increase in wealth that's taken place. Now you'll see that demand peaked massively in 2013. Simple. We all remember the gold market. We all remember what happened to the gold price in 2013. Fell really sharply. Now, sometimes a big pickup in demand like that is counterproductive. When the price falls, people rush out and buy gold because they think it's cheap and it's going up. It encourages retailers to expand their network. It encourages manufacturers to expand their manufacturing capacity. Unfortunately, as we all know, gold didn't recover for another couple of years. So that left a market that was actually too big for itself. So the last few years have seen a reorganization of the Chinese gold market, which seems to be complete now. We've now seen year-on-year increases in 2017 in jewelry demand, and we're seeing investor demand picking up as well. Now, work we've done at the World Gold Council shows you that the most compelling statistic to predict what happens to demand growth in an economy is income growth. And if you think about what's happening in China, still growing 6, maybe 7% per annum, but also refocusing its economy more towards consumption from investment. This looks like a market that's going to continue to grow going forward. India, about as important as China, is an example of what happens when a government is fighting the gold market. India runs a big current account deficit, in contrast to China with its big trade balance and a current account surplus. The two big things in India's current account deficit are oil, it doesn't have much oil production itself, and gold. And when the current account deficit as a whole gets big, the Indian government has historically tried to clamp down upon gold imports because it stresses the overall macroeconomics of the country. That's what we saw happening in 2015, 16, and even into 17. The change that's happened there, though, in the last couple of years, with a new government there, with Prime Minister Modi there, Modi, actually, sorry, Modi, not Moody, Modi. I haven't met him personally. Has recognized, partly I think with the work that we've done at the World Gold Council in the country, in India, recognizes the benefit of gold to the Indian economy. 1st of February this year, they had their annual budget called the Union Budget. The finance minister turned up and said, we're going to recognize gold as an asset class in India. Now, this is an enormously important statement because it unlocks the potential for gold in India to be taken seriously. At the moment, 70% of gold comes from the rural areas, lots of very small, family-owned jewelry companies. They don't pay tax. Much of their jewelry is under carat. You buy what you think is 22 carat and it comes out as 16. All of this is being changed and renewed and going forward such that we can drag the Indian gold industry into the 20th century and hopefully maybe in a decade or so into the 21st century. And this really matters. Not only does India consume about 800 tons of gold a year, but it's got a stock of gold, jewelry, and personal investments of about 25,000 tons. Now let's put that in perspective. 25,000 tons, that's about 8 times as much as mining companies produce each year. It's the biggest stock of gold in private hands anywhere in the world. So India is really important for gold. We think the changes taking place with the Indian government are going to be very positive for gold in India going forward. Technology isn't huge in terms of demand for gold. It's about 10% of total demand for gold, 7 to 10%. But it's in probably every electronic device that's in this room, and it's absolutely part of the 21st century. Every iPhone, every sensor, every self-driving technology, everything that you can imagine is going to grow as we become more connected going forward contains gold. And because gold's expensive, you only use it when you really need it. If you don't need it, you can substitute for copper or silver. But I like to use an example of the electronic contacts in an airbag. This airbag sits in your car, or probably in my car. I think I've got 7 airbags in my car. So there's 7 airbags sitting there doing nothing. Temperature gets down to -10, maybe up to plus, well, in England, 20. In other countries, maybe 30 or 40 centigrade. And it sits there for year after year, and it never works. Until one day, some idiot pulls out in front of you, and bang, you hit them. And then it has to work once. So what do you use when you want to have something that sits there with extremes of temperature, doing nothing, but when you need it, it has to work? You use gold. And that's the example that I'd use with gold throughout the technology. You don't use things priced in dollars per ounce when you can get away with things in dollars per pound. And what we've seen, particularly over the last 10 years as the gold price has gone up quite a lot, is we've seen companies finding ways to use less gold, substitute for other things, making devices smaller. That's come to an end. And we're starting to see increases coming through. You can see it in 2017, first quarter 2018 as well, starting to see these increases coming forward. So if you take a very long-term view about consumer growth internationally, and you think about more connectivity, this is an area, yeah, it's 7 to 10% of demand. That's about as much as central banks have bought in the last 7 to 10 years. We spend a lot of time on central banks. We don't spend enough time thinking about technology. Germany's gold market is an example of what I would like to see every country's gold market be. I can walk into gold stores, and I suppose this is the wrong story for Zurich, because you can do the same thing here. But I can walk into lots of different shops around the cities of Germany. I can buy gold, physical gold at a relatively low premium. I can trust the brand that it's in. And if I change my mind in a couple of years' time, I can walk back in there and sell it and not get ripped off. There's exchange-traded funds, which, as you can see, have grown tremendously in the last couple of years in Germany because there's been a tax ruling, which now means that their tax treatment is in line. So we've got a market now which is around 200 tons a year. And you think, okay, 200 tons at global gold production, 3,200 tons, it's not so much. But on a per capita basis, this is why I like Germany. And there's a chart that I show when I go and speak to people in China and India and say, yes, you consume a lot of gold, but per capita, there's room to grow. Germany, Turkey, I was quite impressed to even see the United Kingdom and the United States on here. We tend to underestimate, I think, that if you add in investment as well, these countries are big. For those of you that are wondering where Switzerland is, there are a few countries with large asset management industries that I've ignored from this chart. Switzerland's per capita consumption of gold would be much higher. But then again, as we all know, there's lots of money managed here for externally. I want to talk about Turkey because I think Turkey is really exciting. Now, if you look at our bar and coin demand numbers here, together with jewellery, you'd say, well, what's John talking about? It used to be a much bigger market, and yet we can only identify about 100 tons a year. So what? Well, this is why. Something is stirring in Turkey. We look at imports, we look at exports, subtract the two together, rolling 12-month imports of gold into Turkey are now at all-time highs, over 300 tons. We know the central bank is buying. We know commercial banks in Turkey are buying and depositing that gold back with the central bank as well. We can see investors buying, and there's the jewellery demand as well. It might be a reflection of the concerns within Turkey about the political developments. It might be a reflection about the weakness in the currency that's taking place. Either way, Turkey is turning into a very large market. I think I might have just pushed the wrong button there. Yeah, I did. This is a market that I referred to before. When gold was $250 an ounce, the US consumed about 400 tons of jewellery a year. As the price went up, this fell off a cliff. This is partly price-related. It's partly due to the concerns that millennials don't buy as much gold. This, I think, is one of the biggest challenges that we in the gold market face, is that developed market consumers in the West don't buy as much gold jewellery as they used to. But it's stabilised. We've done quite a bit of work talking to and working with some of the jewellery companies in the US to try and find out what they're doing to try and sell gold to the next generations. Not the millennials, they don't have any money, but the people that are younger than the grandparents that traditionally have bought lots of gold. In the US, investment's more important. And I think this is an interesting slide as well, because it shows you how back in 2000, this was entirely a jewellery market. You can see how investment has picked up, particularly with the launch of the ETFs. And the ETFs contributed a major component of demand over the next few years. But ETFs are investment vehicles. Gold can be sold as well as bought, and that's exactly what happened in 2013. And if you remember the chart I showed earlier, China bought a tremendous amount of gold. Well, who sold it? It was ETF holders. People who had bought gold in expectation of inflation from quantitative easing sold out when the price broke through about $1,500 an ounce. Fortunately, the physical market picked it up. What we've seen in the last couple of years is we've seen a stabilization and then a recovery to a certain extent. So 2016, good inflows into ETFs in the States. 2017, solid, not as good. And similarly this year, seeing further inflows into ETFs in the States. This is another market, I think, that is very interesting. And again, you'd look at that chart and see the decline in recent demand in Vietnam and say, well, why are we interested? Well, we're interested precisely because of that decline. Vietnam has a chronic inflation problem. The currency, which is quite amusingly named the dong, declines rapidly, and so much so that it is inherent in the psyche of the Vietnamese that you use gold. You own gold to preserve your wealth. You use it in transactions. If you're buying a house, it's entirely normal to walk up with a suitcase full of gold as the deposit. This was so much of an issue that the Vietnamese government took the gold market back under control to try and stop the use of gold in the economy, and they've been reasonably successful. Unfortunately, massive smuggling market has developed. So there's lots of talk and rumblings afoot that we're hearing from the Vietnamese market that the government is about to liberalize the market. That could lead to the sort of growth that we saw in the middle of the last decade and see gold growing back here again. So I share this chart with you last in this section. It's interesting because it encompasses more or less how long I've been looking at the gold market when I left the gold mines in South Africa. When I started off, gold was $250 to $400 an ounce. It was almost entirely a jewelry market, with investment maybe 10, sometimes 0, but 10 or so % of the market. What we've seen take place through the financial crisis and afterwards is the investment market in gold has reignited. Yeah, sure, jewelry's less than it used to be. That probably makes sense because the price is a lot higher. But the investment market is now at the heart of the gold industry. But what happens going forward? Well, I think gold investment is likely to be around for a while. I'll flick through that one. And the reason I say that is if I look at the valuations and the performance of other asset markets, we've come a long way. This is my favorite valuation chart of the S&P 500, the big US equity market. It's the Shiller cyclically adjusted PE, and it's the PE 10. So what it does is it takes the price divided by the earnings of the last 10 years. What it's supposed to do is to smooth out all of the cycles that you get in the US economy. What it shows is, yes, the economy has been more, yes, the S&P 500 has been more expensive in the past, but only in the dot-com bubble in the 2000s. Now, this chart is useless at telling you where shares are going to go in the next 3 months, 6 months, 12 months. But what it is a reasonably good indication of is what sort of returns you can expect to get investing in equities for the long term, like an institutional investor, like a pension fund manager. This is one of the core slides that I use when I talk to them. Similarly, we've had a 37-year bull market in treasuries. You own treasuries, you collect the coupon, bond yield goes down. This has been great. Now, I'm not a technical analyst, and that isn't a technical line. All it is a trend line I've put through there, calculated by Excel. But what you can see is this is getting close to the biggest break that we've seen from this 37-year bull market. And even if it doesn't break, it can't be repeated. Bond yields have come down a long way. They can't come down this much further, certainly not for this much longer. The other important factor in terms of determining gold pricing is what's going to happen to the US dollar. Sorry, too much red wine. What I've tried to do here is to look at the long-term performance of the dollar. I've looked at a US dollar effective exchange rate, so not the DXY, which is a relatively narrow basket, but something produced by the Bank of England that looks at the effective exchange rate between the US dollar and all of its trading counterparties. And what you can see is there's been 2 bull markets in the dollar in the last 40, 50 years that stand out very clearly. The first of them, between December 1979 and February 1985, lasted 6 years, saw the dollar, by this measure, up 54%. The next one, April 95 to February 2002, 7 years, 44%. And then if you look at what happened from July 2011 to January 2017, lasted 5.5 years, up 43%. Now, I'm not saying that the dollar is going to collapse, certainly not. I'm not saying that it's even going to fall. But what I am saying is that we are more towards the end of a US dollar bull market than we are at the beginning. And there's a good chance, I think, that we're going to see the US dollar decline over the next few years. That's clearly an important point for gold. I'll come back to that one in a sec. I've got the slides slightly out of order, I apologize. The other factor that's really important for gold is where US real interest rates are. Now, the positive performance we saw in gold from around 2001 to the highs that we saw in 2011 were accompanied by a decline in real US rates. The fact that we saw the sharp up move in 2013 was one of the factors that triggered the sell-off in gold then. Since then, rates have been pretty stable between 0 and 1%, and we're approaching the high end of that range now. But all the academic exercises that I've read suggest that real US interest rates are going to remain low, constrained by low productivity growth, constrained by an aging workforce, and a propensity to head to safe assets. If that's the case, gold should do relatively well in this environment. Of course, if we do see real rates go back up to the levels we saw in 2003, 2005, clearly that will be a headwind for gold. But if you think back to what we were seeing then, we were seeing rapid economic growth of 3 to 4 to 5%, strong productivity growth in the States. I think those days, at least now, appear to be behind us. We put this exercise out. We did an exercise late last year, published it early this year, looking at cryptocurrencies and gold. The reason we looked at cryptocurrencies is because all we could see everywhere were the headlines about how Bitcoin was the new gold and how it was going to take over from gold. Now, one of the things that we concluded in this paper, and by the way, all of our research is available on our website, absolutely free, all you have to do is register, is there's lots of similarities between gold and cryptocurrencies on the supply side. Cryptocurrencies are, like Bitcoin particularly, are designed to have a finite supply and to increase relatively slowly. That's quite similar to the supply profile for gold. But the demand side's very different. Gold has real applications in jewelry and in technology. It has a dynamic investment base that takes place on regulated exchanges and other trading venues that are supervised by markets. You can buy gold and you can short it. All of these factors has made gold a valued asset for something like 6,000 years. Whereas cryptocurrencies, much more new, interesting, exciting. I actually own some, lost some money on it, but that's another story. But what I would say is that it's not a substitute for gold. They're very different assets. Now, there's no doubt that blockchain, and we heard that from TradeWinds today, blockchain has a lot of interesting potential in the gold space, and I would not be surprised to see some gold-backed digital token successfully out there, but that just enhances gold. I don't think it threatens it. This, by the way, was a Google search run I ran in, I think about April. We'd seen, obviously, Bitcoin go stratospheric and exponential in the fourth quarter and then collapse thereafter. And this was perhaps the reason that we focused upon this, is that all of the oxygen of publicity towards Bitcoin was completely overtaking what we were hearing in gold. That seems to have slowed down quite a lot. And reading today on Twitter, apparently this trend has continued, although I haven't updated this chart. I think the final thing is as well, and this is more a short-term phenomena, speculative positions on Comex are in neutral territory. Now, again, this doesn't really tell you anything about where the gold price is going to go, but it does tell you about where the vulnerabilities are. If you look at the end of 2015, Comex positions got down to virtually zero. We did see a big rally in the gold price in the first half of 2016. When those positions got pretty full around the middle of the year, there was kind of no real energy to take it higher. So we're at neutral territory at the moment. I don't think this chart tells you a hell of a lot, except to say that it could either go up or it could go down. But it is worth keeping an eye on this stuff, and we do write research on it and tweet about it from time to time. So finally, these are the last 5 slides. I'll run through them quickly. This is what we try and say to people when we're making the case for gold in a portfolio. People think of gold as a safe haven, and it is. It does well during times of crisis, but it's also been a source of returns. If you look at the performance of gold on a 10-year, 20-year, or since 1971, its returns compared to other asset classes have been very similar, and in many cases, better. It's a potent diversifier. I mean, we all know about the diversification benefits of gold, but I'll show the second chart because I think it's really interesting, because what it shows you is it's diversification that works best when you need it. So looking from a US perspective, when the S&P 500 is going up quickly, when it's going up by more than 2 standard deviations, gold is positively correlated, so that's good. But when the S&P is down by more than 2 standard deviations, guess what? The correlation flicks negative. So in other words, you're getting protection when it goes down, you're getting some benefits when it goes up. And that means putting gold into a portfolio works really well. It's a deep and liquid market comparable to other asset classes. If you look at it on here, comparing it to, for example, UK gilts, German bunds, even the Dow Jones 500 stocks, this is a deep liquid market. Sure, there are some things that are more liquid than it, JGBs, treasuries, etc. But this stands up as an asset that deserves to be at the top of a portfolio decision, not as some specialist niche thing. And finally, this is a chart I particularly like. And what it shows you is currencies compared to gold. In the end, sorry, I actually should have put the Swiss franc one in here, because the Swiss franc's done better than all of them, but it's still down versus gold. Just a quick plug. I run research and strategy at the World Gold Council. We produce high-quality data, gold demand trends. It shows the good and the bad. First quarter gold demand down 7% compared to last year, and the lowest quarterly first quarter demand number for 10 years. You know, this is the truth. We don't mess with the data. We produce authoritative reports and commentary. Just published a document looking at how the gold industry might develop over the next 30 years, called Gold 2048. We produce quarterly documents called Gold Investor, which gets external people talking about the gold market. We've had Mohammed Al-Arian, we've had Alan Greenspan, we've had some others as well. I think we're the largest gold research team in the business nowadays, and it's free. www.gold.org, sign up, get our research, get our data, get our insights. And you can follow us on Twitter. Gold Council is the main one. It's boring, it's not as good as mine, which is Reade at WGC. And Alistair Hewitt, who does the World Gold Council's research, supply and demand research, is quite good as well. And I'll finish there. Thank you very much. Now,
thank you very much, John. Yeah, questions? Uh-oh. None? Oh, there's
Okay.
one. There's Matthew.
Oh, thank you. That was a very good summary of the demand side. I was wondering if you can just give us a few comments on or your views on the supply side. Thank you.
sure. I mean, I suppose the first thing I would say is I'm not going to argue with anything that David said. The work we've done looking at all the listed public data of gold mining companies and their long-term plans suggests that gold supply peaks this year, maybe next year. There's always a bit of variability in there. And then it probably declines at 1 or 2% per annum for the next 5 years. My suspicion beyond that is that it probably declines a lot faster after that, because the gold industry hasn't really invested in many decent-sized projects. I mean, exploration and discoveries is one thing. There haven't been a great success in particularly greenfield exploration in the last 10 years, but there have been some. And there's some decent-sized projects out there that could be started tomorrow, but the gold industry struggles to get its mind around $5 to $10 billion capex bills, probably for good reason. It's difficult to generate a return on those. If you think about what the gold mining industry did to become competitive again after the fall in the price in 2013, I mean, it cut costs, it cut G&A, cut overheads, cut exploration a bit, but it also cut project development. And if you think about a gold mine might have a 10 or 15-year life in terms of proven reserves, yeah, you can add some of that to brownfield, but if you think now we're 5 years on, there hasn't been that many projects started. So unless the gold industry gets busy and starts, you know, manning up and committing to some of this big capital expenditure, then we're going to see a decline in production. Certainly from the universe of companies that we look at. Now, China's a bit of a left field here. You know, they're the largest producer in the world, and that's something that's come along in the last 10 years or so. They came from about 200 tons to about, what, 450, 500 tons now, have been growing really rapidly. Difficult to get insight into what's going on there. They don't seem to have reserves. They don't drill. They just kind of mine and, you know, hope for the best. And that's done them well so far, although production did decline last year for the first time, partly because of an environmental crackdown. So we're not too sure about what happens there. And then there is growth coming apparently from Russia as well. But you know, those two areas aside, I think we're in for I'm not a believer in peak gold. I'm a geologist and I'm a mining engineer. I know that stuff's there, and I know we can mine it. A lot of it's in countries you don't want to operate in, and a lot of it requires a lot of money that the industry doesn't want to finance. The other perhaps more controversial comment is that doesn't really matter very much. 3,200 tons of gold produced a year. The total stock of gold above ground is 190,000 tons. We could stop all gold mining tomorrow, and you could all get as much gold as you needed forever. You would pay a lot more for it, of course, but it's available. If you push the price up $300-400, you'll get more scrap. If you push it up $3,000 or $4,000, you'll get considerably more scrap. I mean, and this is one of the things about gold that differentiates it from other commodities. You know, you dig it out of the ground, you refine it, you turn it into things, and it never goes away. So it is there. But I think the mining industry will be around for, you know, for the rest of my working life and well beyond there. But I think it is going to struggle to keep production levels at current rates, and that we could see some declines. Yes, sir, at the front.
So what is the latest investment vehicle you from the World Gold Council help to develop, and where, in which country?
Okay, the number of principles that we try and follow. If the market's working well, then we don't get involved. So lots of people at the moment are developing blockchain-based gold investment vehicles. If those are successful and they do the job that they're designed to do, then we would see no need to get involved. Where we have got involved recently, for example, is in the London gold market by launching a joint venture with the London Metal Exchange called LME Precious. We did this about just over a year ago, actually, to introduce a spot and futures market in London, which would assist the local London gold market to reduce the costs of trading. With all the new regulation coming in, the amount of money, the amount of capital that banks have to put aside to hold gold positions, it made a lot of sense to put it into a listed market where central counterparty cleared, etc., reduce the risk exposure. So that's an example of a market we've got involved with. We are in the process of launching a new ETF product in the US. We are subject to a revised S1 filing at the moment, which means I can tell you nothing about it, unfortunately, for regulatory reasons. But in the next week or two, well, first of all, a lot of information is available online already for the filing, and in a week or two's time, there'll be full disclosure. So this, again, is an attempt to open up gold investing in the United States to a slightly different target audience than the one that is served by the ETFs that we have over there already. But for regulatory reasons, I can't tell you anymore. Suffice to say, 6 managing directors at the World Gold Council, and one of those is in the area of market infrastructure and disruptive technology, looking at opportunities for us to get involved in segments of the market which we think can be better and can result in more buying of gold. But there's a few things in the background, and I'm certainly not going to tell you what they are.
Okay, one more. I have maybe one more last question for you. It's maybe a little bit provoking, and it's not of academic, but to me, in the last years, the gold market felt like myself climbing up a mountain, and I'm climbing up, and it's tough for me because of my weight, but all of a sudden comes the glacier, and I feel much colder, and then comes the glacier fall, and I'm falling. And it happens on 2:30 in the afternoon, and I see selling on the Comex like $3, $4, $5 billion within 5 minutes, 10 minutes. When do we get rid of that? Because I think this is the major chain we have in the gold price, because we all agree the fundamentals are really positive for gold, because I don't understand what must happen in addition in the world, what we have now. We are 70% higher in the debt than 2008, 2007. We have war everywhere. We have funny presidents in the US, in Russia, in wherever. And I don't get it, why we are not already at, let's say, 2,500, not because of a crisis, just because of inflation adjusted from February 1980 when it was $850. So sure. To me, it's like Comex is sometimes like, I'm a little bit rude maybe, but I say it's bullshit trading. So maybe what needs to happen?
Fine. How long have I got, Patrick?
Maybe you can make a short answer.
All right, there is no short answer. A number of things. Yes, the inflation-adjusted price from 1980 is about 2,500. That's absolutely the highest price that we ever had in nominal terms and gone forward. Are things as bad now as they were in 1980? Was somebody trying to squeeze the crap out of the silver market at the time and drove it up to $50 an ounce? I mean, there was a lot going on there. Were hostages taken in Tehran? Did you have a poor president? Bad example. I don't think we're quite there yet. Okay. Comex trades a lot of liquidity, 20 to 40 million ounces a day. And as you say, sometimes 2 or 3 of those million of those ounces trade in a very short space of time. Looking from the outside, and believe me, we have, there is a lot of, you see the spikes in volume, you see the falls in price. Sometimes you see the spikes in volumes and you see the price go up as well. So it does cut both ways, but it does seem to work more on the downside. I'd take that. There is, there are certainly some narrow periods of suspicious activity. We don't have the data. We don't have access to the trading books to be able to go any further than that. The CFTC does, the Commodity Futures Trading Commission of the United States, does have that data and does fine people for bad behavior. What I would say, we are spending more time looking at this, not only with our own skill set, but with external consultants than we have ever done before. And that's all I'm going to say on that. Because I would say, I share your frustration. I mean, I was on a chairlift skiing in France, I'm sorry, not Switzerland, in 2015, and every time I updated my phone, I did a run, update it on the, and we were $50 lower. Yeah. And I was getting calls from the boss in New York, which wasn't good. So I do share your frustration. There do seem to be some very big trades going through, but what I would say as well, there's a lot of technical-based trading that takes place in futures markets. People tend to put their stops close to each other on moving averages or RSIs or all of that bollocks. And when the price gets sold and starts going through these levels, they can cascade down. So I'm not saying it's definitely happening, but I would. There is definitely periods of very high volume. Do I think the gold market's a fair gold market? Well, I've looked at all the convictions that have taken place and of people that I've known in the gold industry that have either been convicted or have been accused and let off, and seen what's gone on. And I think, in general, yeah, there is nastiness in the gold market that takes place. It tends to be short-term. It tends to be manipulated. It tends to be around, historically, the fixings and things like that. Is it distorting the price sustainably and more than a couple of dollars for a couple of minutes? I've never seen any evidence of it. But believe me, we are certainly looking forward at the moment.
Great. Good to know that.
Okay.
Thank you very much, John.
Thank you.
Yeah. Thank you. Yeah, ladies and gentlemen, thank you very much for your attention. I think there's some dessert served, I think. Yeah, Patrick, okay. It's not only show the fork in the... Good. Yeah, thank you very much for, again, hopefully for your enjoyable evening, and thanks that you have attended here and for your attention. Always a pleasure to do that here, and also thanks to Andrew and Patrick Michaels for setting this up, and thank you very much to David Garofalo, the CEO of Goldcorp, with a fantastic presentation and a beautiful panel. Also, Fraser, where are you? Here are you. Fraser Buchan, thank you very much. It was very great to see insights into your certain platform and technology. And John, of course, you were last but not least. Thank you very much for your insights into the gold market. It's always appreciated. And so from that perspective, please use the time now with the dessert to network a bit, to talk to our CEOs, to our company representatives, and of course also thanks to StepGold. Just sorry, did not want to forget you, as you were also a table sponsor here. And thank you very much. See you back on 6th November. There will be then, I think it's upstairs in the... It's also here? Oh, sorry, okay. It's also here in the Aura, fantastic. You will probably see me also on the stage. I ensure already today I will have green pants. And the most important thing in life is, as always, stay healthy, enjoy the summer. Really, we have great summer already so far. I ordered some more sun for July and August when we all have vacation. So please enjoy it, stay healthy, take care. Thank you very much, and see you soon.